Okay. Recording. So thanks for. Whoops. Let me go ahead and mute everybody here for a second too. Let's see. I think I muted myself. Let's.
Yeah, you did.
Can you hear me?
Yes.
All right. I apologize. All right. So let me try it again here. Yeah, I guess I have to mute each person individually if there's some background noise, and try to do it that way. I think when I mute all, I wind up muting myself too. So, all right. Well, thanks for joining me, and I appreciate it. I'll kind of kick off. This year's been very interesting, and it's been extremely volatile. And our focus, as always, is to get our clients current income. And this chart is probably always the most important chart that I like to show. Is that over the last decade plus, 12 years, we've always got our clients current income in good times and bad, so that your personal financial circumstances, whatever they may be, some days you're going to wake up and the market's going to be tanking, and some days it could be up and you could feel good. The important thing is that the income that's generated to your portfolio is going to stay relatively stable. So we'll have our ups and downs in the stock market. We'll have our ups and downs in the prices. We've been through an Iraq war. We've been through 2 Iraq wars, real estate bubble, financial crisis, numerous European crises, now the Greek. Well, we're not going to have a Greek exit a lot. We sent out the newsletter actually today, which did anybody receive the newsletter yet? We fired that off this afternoon, I believe, which I talk a lot about the Greek situation. So these types of crises are normal and part and parcel of thanks, Lee. Part and parcel of the of investing, and we're going to go through natural cycles, and that's just part of investing. This year, again, this has always been our focus, is to try to get our clients a 4.5% distribution rate. For those who need it, they can take it and not worry about retirement. For those who don't need it, they can effectively reinvest those dividends and interest. So the first thing I kind of pulled up was just year to date, what's going on with our portfolio. Let me find that quick performance report here. Right now, our portfolio is pushing out. If you look at all of the stocks, our U.S. stocks have dividends of about 3.5%. As you can see here, 3.6% all of our U.S. stocks. Our international stocks have dividends that are a bit higher, at about 4.3%. And our bonds are a little over 7% on the coupon. So with 40% of the portfolio invested in bonds and 60% almost, or about 55% right now in stocks, that's a yield over 5% a year right now. So, and that's, if you look at what's happened this year, the market's kind of done a crazy gyration, and really, if you can kind of see that right here. The stock market has been exceptionally volatile this year. We've had, you can see U.S. stocks, which is this red line, is the S&P 500. It's up about 2% this year. International stocks, or international value stocks, are up about 4%. They were up a lot higher before the Greek crisis kind of hit. You kind of saw the sell-off that occurred here. So international stocks were a lot higher, about 10, 11%. Bonds are not doing very well this year. You can see the aggregate bond index is down. That's this blue line, or excuse me, the the pink line, the thicker pink line is down 2%. And then high yield bonds are down a little bit this year, not including their interest payments. And then lastly, value stocks, the way we invest, are down this year. So we've had basically this year where if you look at it, we've gone up and down, and really haven't gone anywhere. So if you take our whole portfolio for our clients through yesterday's close of business, and this is the whole 200 million that we manage for our private clients, we're up about 0.5% this year. We're not up much. But I wanted to point out the most important aspect of that total return is that on your performance reports, when you get them, you'll see, the dividends and interest is one line. It's called an income line. And you can see this year we've had client contributions come in with new clients of about 20 million and withdrawals of about 8 million. Our clients are definitely taking income out, and that's good. That's positive. That's you living your retirement and taking that income out. But the most important thing I always like to point out is this interest and dividends column. You can see we're just under $5 million has been paid out to our clients this year. So that's that 5% a year. That's going to be steady. Instead of being up 0.5% or 0.43% this year, we could just as easily be down 10% right now. And of course, if we were down 10%, you'd be concerned and nervous about the market, as I would be. But that's not going to impact your income. It's not going to impact your retirement. It's going to impact my income because I get paid based upon this portfolio value. So those ups and downs impact me and they impact my revenue, but they don't impact yours. Your revenue comes from the last chart, last table I was showing you, where that interest and dividends is coming out, and that's the stream of income that's there for you. Now, some of our clients, you can see our clients take out a little bit more than that income, and we always say, it's a competition sometimes of us trying to stay ahead of your income needs, and it's your money. And when Tara and Annie and Chris, our new advisor coming on board in the Raleigh office, when they do distribution planning for our clients, that golden rule is usually 4.5% that's sustainable. So our clients aren't investing in hope, though, because the interest and dividends is there for them. The stock price of McDonald's and Pepsi and Caterpillar and Ford and GM, that's going to fluctuate. That's going to go up and down. But the dividend stream and the interest stream is not going to fluctuate very much. I mean, we could lose 20%. The 200 million that we manage could go down to 150 million. That still wouldn't impact the dividends and interest, would stay relatively the same for our clients. And we've been through that when we had the horrific downturn of the financial crisis, which this chart will show you here. When we had this downturn, you could see we lost 25% of the market value. But this green triangle, that income never changed. The income was always there for our clients. So they didn't have to worry. None of our clients had to go back to work. None of them had to change their lifestyle. If they didn't panic and force us to sell the stocks that we own or the bonds that we own, they were okay. And they lived and had and maintained a good and solid retirement income stream for themselves. And so that's the same case now, effectively, when you look at the current income that's coming into the portfolio. Yeah, everybody would like to see portfolio values higher. Personally, I don't like to see that because I like to buy companies at a value price, and you've seen me sell companies along the way this year, like Eli Lilly. We've sold at 120% return over the last few years, and DuPont and others that I commented on the last newsletter. It's nice to see those kind of gains. Our clients obviously have to pay taxes on those gains, but most of the total return, and remarkably, our clients who've been with us for a decade plus, which some of you who are on this call have been there, if you go back, I mean, if we go back just 10 years, let's say I go back to 7/13 of 2005. At that time, I was only managing for our firm, it was probably around, let's see how much it was back then, 70 or 80 million. as a computer calculates here. But I wanted to show you the importance of it's nice that we could say, hey, we've doubled our clients' money over the past decade, and that's important. That's a very important fact that we, for those clients who've been with us a long time and have remained patient. You can see that we've had nice returns, or 62% returns after fees over the last 10 years. But of that 62%, or 5% a year over the last 10 years, you can see a big chunk of that 58 million, $47 million or so was made up of dividends and interest. So 47 divided by 59 is 80%. 80% of the total return has come from dividends and interest. Now, in periods when we've had more stock appreciation, then that 80% is a little bit lower. But the important fact I wanted to show is that dividends and interest make up a huge percentage of the total return. It's not sexy. It's not the stuff that people talk about on CNBC. It's not Tesla stock up and down. It's a slow and steady approach, but our clients who've been with us for a decade plus really see that compounding effect of that return. And the portfolio reports you get, kind of wanted to show you the this here too, because this will your quarterly reports. You know, when we send them out to you, and I know only about half of our clients incredibly actually look at their quarterly reports. And here's a sample client report that looks like yours and mine, because I'm invested in the same stocks and bonds that you are. So when you look at your quarterly reports, that first page, you'll kind of recognize this is a real client who's been with us a long time, and you'll sort of recognize that. Somebody's making a little noise here. I'm gonna try to. If I mute everybody here, it's gonna mute me too, though. So let me try something new here. Okay, hopefully you can still hear me, but I've muted everybody else right now for a moment. Can you hear me? Can somebody chat with me for a second and tell me that they can hear me, just to make sure? So this report that you get on a, thank you, Miss Lemmy. This report that you get on a quarterly basis will show you, like last quarter, this client, we had, like most clients, like this year, in fact, we haven't had much return. We had realized gains, meaning we sold stocks at a gain. This is a real client. We had unrealized gains, meaning the stocks and or bonds have gone down in value during the quarter. But the income received for this client was $71,000 for that quarter. And he was only taking $19,000. So he's only taking about 2.5% a year. The income's going to be nice and steady for this client. As the next page will show, when you look at your report, you can see this is your income page on an annual basis. This client's going to get $251,000 a year in income. That's going to be relatively steady for the client. And again, here you're not investing in hope, because regardless of the price fluctuations day to day, you know, we're investing in McDonald's for the next 10 years. I have no idea what McDonald's is going to do today, tomorrow, next week, or next year for that matter. Nor do I care. I'm most focused on getting it at a reasonable valuation, getting paid while we wait, that McDonald's, like other companies, as you can see here, are paying you current income. That way we can be patient and wait for McDonald's to realize full value. And when it does, at that time, if it gets ahead of itself, then I'll sell it. I'll kind of talk about sell discipline a little bit later too. So that's what we're doing when we're buying the bonds and the stocks for you. It always has to pay our clients in order to get you that current stream of income that you need in your, in your retirement years. So especially in your retirement years. So it's nice that we could say, hey, we've doubled our client's money. Again, this is a real client, very a good example of our clients and the returns that we've had for them. Yeah, we've made them 110, 20% since 2002. However, you can see he went through a horrible dip, just like all of our clients did in the financial crisis, where we lost 20, 25% in 2008. but his income didn't change, and that's really the key. And that allowed us to stay in, and you can see recovered over the next year and a half. And again, that's just a price fluctuation. So I wanted to show that report that you get each quarter. Annie's already sent out an email saying that these are ready on your document vault. You can go to our website. If you don't do it, 50% of our clients don't even look up their quarterly reports. I mean, we send them to you. Our advisors will send them to you, but you can always just go right to our website. And if you go to the login area here, to the Altrius document vault, you just come in here, put your username and password in. If you've lost it or forgot it, just call us and we'll reset it for you and put a new one in. And you can download. You'll be able to download these reports. We also have a realized gain loss report that we've done because the good news is we've had a lot of gains and realized gains for our clients from the stocks we sold. The bad news is that the government wants their cut of your gains that we've been able to make for you, and so a lot of clients have to plan for those returns. Let me see if I can unmute everybody here, see if there's any questions as we go. Does anybody have any questions you want to throw out to me as we go for something I'm covering? Nothing. Okay. All right, so I'll talk again about how we're doing this year. You know, our stocks are doing very well. You can see international stocks are up 4%. That's the only, from a relative basis, that's the only area we're lagging. Our international stocks are only up 0.5%. We're very heavy on international stocks. If I took this back just 2 weeks, you'd see we were doing a lot better. You know, Total and Eni, an Italian oil company, or British Petroleum, Royal Dutch Shell, those companies have taken a hit recently with oil prices kind of coming down here the last couple of weeks. Our U.S. stocks have done exceptionally well. Large value managers are down for the year. We're actually up almost 2% for the year. Growth stocks are outpacing value stocks right now. As you can see, the S&P is up right around 2%. Bonds are in negative territory this year, but our bonds are doing well. You can see we're up 1.2%. So again, we've got about just under 0.5% return for our clients this year. Nothing to write home about, but our bonds are doing relatively well on a relative basis, but not on an absolute basis. And I'll kind of show you that too here. And again, one of the things that I like to talk about is Treasury yields. We're in a low interest rate environment, and in a rising interest rate environment, bonds get hurt, and that's what's happened this year. The Barclays Ag has not performed very well. So if you look at even, say, here's the high yield bond market, HYG. This year's performance is up about the same as us, 1.3%. The Barclays Ag is actually down, you know, the bond market, and the Barclays Ag is down because interest rates have started to rise. And this is going to be a bond Armageddon because we've had a 30-year bond market where bond yields have continued down, which means prices have gone up, right? Because yields intersect with price. So we started the year with a 2.1% 10-year Treasury, which is, you know, good for your mortgage, and it was going down even further as there was some fear at the beginning of the year. But then what happened was rates started to spike pretty quickly when the Federal Reserve talked about raising interest rates. We actually hit a height at one point of 2.5%. Right around, when was that? Let's see, it was June 10th. We hit 2.5% on the 10-year Treasury. Subsequently, the Greek situation has caused rates to go down a little bit. So right now we're at 2.4%. The problem is 2.4% does not get you to a comfortable retirement, and nor do you want to sit in a 10-year Treasury right now where your money gets stuck. So, for example, if I invest $100,000 for you and I put it in a 10-year Treasury, we know that you're going to get $2,100 for the year. Every year you're going to get $2,100. And you're going to get your $100,000 back at the end of that 10-year period. However, if interest rates go up 1%, you've lost 1% per year that other buyers of your bonds now have to get, because the U.S. government is issuing new debt, and it's issuing it at 3.5% yield. So new buyers are getting $3,500 a year rather than $2,400 a year. And to compensate those new buyers, your $100,000 has to go down to about $90,000. And that's how bonds can lose money. Now the benefit is for us and for our clients, we've done very well in a rising interest rate environment, and we own the individual bonds for you. So this happened in 2013 when the 10-year Treasury went from 1.6 or 1.8% in 2013 all the way up to 3%, and that just destroyed. That really, you can see that here in 2013. That really destroyed the bond market, and most bond funds, ETFs, were down about 4% on average. Our strategy was actually up 8% during that year. And we've performed well in a rising interest rate environment because we're focusing on higher yielding issues right now because they're less interest rate sensitive. Because if the economy is improving, that generally means that the companies we're investing in, their bottom line is improving, and they're not as interest rate sensitive. And to show you in a real world scenario, I'm going to show you the bond portfolio, and we'll talk about Post Serial. So Post Serial is a company that we just bought. For most of you, you've seen it in your portfolios. So I'm going to put up Post here. The computer will take a little bit to calculate all these bonds. Let me make this a little bigger. So I'm going to go down to Post Serial here. Now Post Serial owns, of course, it's the cereal company. So you got really healthy cereal like Kellogg's, and they bought Power Bar from Nestle, which we own too, the Swiss chocolate company. So Post Serial bonds will fluctuate in value. We paid 102.8, right? So we paid what's called a premium. I paid greater than the par value for Post Serial for our clients, and we bought $670,000 worth, because not only do you have risk inside your portfolio, but we have risk too. We don't want, if I'm wrong and if Post Serial goes bankrupt, I don't want to decimate your portfolio if we have a default, which we're certainly going to have at times, and I also don't want to default the whole of Altrius' portfolio that we're managing. Now for our clients, it's only going to be about 0.5% of your portfolio. That $670,000 is throughout all of our clients. So when you look at your statements, you'll see if you have $1 million with us, you probably own about $5,000 or so of Post Serial, maybe as much as 10 at the most, depending on your income needs. As long as Post Serial doesn't go bankrupt between now and February of 2022, you're going to get a 6.9% return. That doesn't mean that Post Serial might not go down to $90 tomorrow. It could. People could get nervous about Post Serial on an individual basis. People could get nervous about Post Serial because they're worried about high yield. People could get nervous in the short term with interest rates rising. But you have a huge advantage over our clients who we manage money for on the institutional side through the mutual fund that we manage, because in your portfolios you own the individual bonds. I own the same bonds that you do. I own Post Serial like you do. And it doesn't matter if I have to sell Post Serial. If I get called up by some advisor in Chicago who wants to sell his client's position, I have to sell Post Serial. And Post Serial is pretty thinly traded. And you'll see the price go down just because I'm selling it. You'll see that I sold $20,000 for a client, or let's say we had to sell a full $500,000 for a large institutional client. You'll see Post Serial go down in price, and you'll see it go down on your statement. But it doesn't matter. It's just the price changed that day. You're still going to get your $100 back, and Post Serial is still going to pay you 7 3/8% yield every year on an interest payment on that coupon payment. And that's what we're doing when we're investing. And it's the same for companies like Revlon, you can see, which we paid a little more than $100 for, and it's at 98 cents on the dollar. We're getting a 6% return. Or Rite Aid Drugstore, or Ruby Tuesday, or any of the other bonds that we're buying for our clients. Bonds will fluctuate. Bonds are volatile also. Not quite as volatile as the stock market. The stock market will go down 3% in a particular day. It'll go up 3% in a particular day. High yield bonds will go down a third to half of that volatility. But that doesn't matter. The volatility on a day-to-day basis doesn't matter. What does matter is the credit risk, is default. And I'm going to make mistakes. Radio Shack is a mistake. Ram Global is a mistake. These are when companies go bankrupt, and we, through the bankruptcy process, hope to recover 20 cents on the dollar or 30 cents on the dollar. Sometimes we get more back. Sometimes we've gotten 90 cents on the dollar. Sometimes we get nothing back. It really depends in an Eastman Kodak type situation. Now, we stress test a portfolio. So one of the things that we do is look at a worst case scenario. So I wanted to show you a worst case scenario for our clients. The first part of the worst case scenario that I want to show you is our scenario analysis. So if you read the newsletters, you'll hear me talk a lot about scenario analysis. And what we're doing with scenario analysis is looking at a worst case scenario and a best case scenario and a most probable and a likely scenario. Let me find our scenario analysis right now. Actually, this scenario analysis is dated. Let me get the most recent scenario analysis as we update our presentations, which I just did a week or so ago. Where is it? I'm going to find it here, or maybe not. I know I just sent it out to the rest of our associates the other night. I could try to find the email, but this might be it here. No, that's not it. It's a newsletter. All right, I'm going to leave it be here. We'll just go off the last one here. But part of the problem right now is that stocks could make as much as 50% over the next 5 years, U.S. stocks. And international stocks could do even a lot better, particularly in Europe. We could see incredible returns for international stocks of upwards to 90% over the next 5 years. On the other side of that, a bear case, those who go on CNBC and the doomsayers, we could have losses of 25% for both international and U.S. stocks over the next 5 years. Also possible. I've also never seen in 19 years of doing this such a large range that we've had over the last 3 years or so. We've had such a range of possibilities. The truth is probably somewhere in the middle, this base case scenario. You can see our outlook for U.S. stocks, though, is not great right now. So you've seen me go from 13% international allocation at the beginning of last year to now we're at about 20% international exposure because the outlook is for international stocks is a lot better return. Now, why we're not investing in municipal bonds, why we're not investing in treasury bonds right now is that treasuries and quality high investment grade bonds, higher quality bonds, get horrible returns in every scenario, best case, worst case. So it effectively guarantees you don't get to a comfortable retirement. So why I focused on high yield bonds over the last 5-6 years is that's the best opportunity set for our clients. In a bear case scenario, we get a 4% return. In a best case scenario, we get about a 4% return. In our base case, we get about a 5%. If I do a good job of picking bonds for you, we do better. We'll do about 7 or 8%. Now, this bear case is a worst case scenario. Let's look at a horrific scenario. Let's say that I'm really wrong, and let's say we go through another horrible financial crisis. And in the financial crisis, we actually had a worst case scenario that was worse during the savings and loan crisis, which you may remember from the early 1980s. And during that period of time, we had 30% default rates. Really, really bad scenario. So we take our scenario, and let's say under that scenario, we have, again, 30% default rates. That means that out of all the bonds you own, of about, let's say you have about 80 in your portfolio, that we lose about 25 of them. 25 of the 80 companies go bankrupt. Revlon, Avon, Ruby Tuesday, we just lose just mass chaos, and we lose 30% default. At our current yield of about 8% on your portfolio that we have for you, let's say we only get 35 cents on the dollar recovery through the bankruptcy process. We would still get a little more than 2% rate of return, which is still better than you're going to get from treasuries right now, short-term treasuries at least, not necessarily a 10-year, which is a 2.4. So the risk reward is very good for us. So I know that bonds can be volatile. I know you've seen some defaults in your portfolio, and I know that sometimes it's scary to invest in high-yield junk bonds. However, companies like Post and Burger King and Revlon and others are compensating you for the risks. And the spread right now at about 5.5% from Treasury is about where it's at from a historical basis. So we still really like high-yield bonds. Again, I'm going to open it up here again to see if anybody has any questions regarding bonds, because bonds could be really, really complex, and I kind of want to dig into bonds a little bit for you, since our clients have so many questions for our advisors on the bond portion of their portfolio. When they're looking at them, we'll hear things like, "Oh, we're worried about J.C. Penney going bankrupt," and I'll say the same thing. I'm like, "Yeah, I'm worried about J.C. Penney going bankrupt too." I don't think they're going bankrupt. I think we're going to get a nice 6.3% return from our 2018 notes. I think we're going to get an 8% rate of return from our 2020 notes. However, if I'm wrong, we're not buying the farm with J.C. Penney. We only have about $500,000 invested with J.C. Penney, so it's not going to be impactful if J.C. Penney goes bankrupt. We're not going to get the great 8% return that I want to get. You can see right now our total yield, I'm staying very short term. Our duration's only at 3.3 years, so we're staying short term because of potentially rising interest rates. And you can see our yield to maturity is at about 9. So I'm being conservative at saying 8. Maybe we get 7 if we have really higher type defaults. So there's a lot of great companies that we're investing in. And it could be a company like PHI, which transports people out to rigs in the middle of the ocean. The risk to a PHI that we lose this 7.5% return is that the energy companies start boating their people out to the rigs. Yeah, that's the greatest risk, rather than helicoptering them out. Outer Wall, you'll see this company here, Outer Wall. They make when you walk into a supermarket, whether it's a Harris Teeter if you live in the South, or whether it's a northern supermarket like Tops that we owned in the Northeast in New York, or a ShopRite in New Jersey area, you'll see the red boxes and the blue boxes. The red boxes are for you to put $1 in to get one of those movies. It's cheaper than if you go on. The risk to an Outer Wall, of course, is that we go on Comcast or our cable company and pay $6 for the movie rather than the $1 that we pay for that movie in the ShopRite or the Harris Teeter. They also do the Coinstar. So when you go in there with your pile of change and you throw it in there and it change, you pay them 10% and they'll give you the cash for all of your change that's in there. Those are the kind of companies that we're investing in that have good cash flow, and we hope, again, don't go bankrupt on us. And we're very well diversified by owning more than 80 names on the bond side of our portfolio. Again, it could be a Netflix. There's no way we would ever invest in Netflix, the company. Not going to invest in Netflix because I'm not going to pay some ridiculous valuation. I don't ever have plans on selling my company, but if somebody offered me 100 times earnings, it would be hard to pass that up. If somebody came by and said, "Hey Jim, we want to pay you $50 million for your company today," that might be hard for me to pass up. Well, that's what you're doing when you're buying Netflix. You're paying more than that. You're paying 183 times earnings. That's crazy. I mean, why would anybody pay 183 times earnings for a company, or that's selling at 225 times? Now, that's growth investing, right? Netflix is not paying you a dividend. Again, the whole reason for our being, and how I started this presentation, was to get our clients current income, to give them a safe and comfortable retirement. Netflix is not going to do that. You're investing in hope. You're paying $702 for Netflix today. You're hoping that it goes up so I have to sell some shares to get you that income. We don't invest in hope. We're investing in Chevron. Chevron's selling at a reasonable 10 times earnings. It's paying you more than 4.5% dividend yield. I think Chevron's going to be worth $200 10 years from now. I could be wrong. It could still be worth $100. It could go down to 80. It can go down to 80 next week, right? We could have Iran flood the economy with market oil prices go down to $20. Chevron can go down 20%. It's possible. But Chevron's earnings can get hurt and impacted because they're making $9 a share. Their earnings could lose at $2, and they're still going to be able to cover their $4.28 dividend, which keeps you in that comfortable retirement. That's how we invest. We invest for dividends. We invest for income for our clients, and eventually, Chevron will go up in price. What I try to get our clients to think about is not the price. They're going to pick up their statements, those quarterly reports I showed you. They're going to get nervous and say, "Oh my God, Jim, you're an idiot. The stock market's down 10%. What do we do?" And I'm going to say the same thing. Focus on the income. Don't change your life. Don't panic right now. Keep collecting that dividend from Chevron. Keep collecting that interest payment from Ruby Tuesday. Don't worry about it. This too will pass. We've been through crises before. We'll have crises to come. The people on TV are going to comment about the crisis du jour. That's not usually the one that's going to hit you. It's the one you don't see, right? The train that's coming, the big light in front of us down the tracks, we can get out of the way of that one. It's the one we never see coming that impacts us. It was easy for me to call the bubble in the real estate market. It was easy for me to call a bubble in the tech market in the early 2000s. It was easy for me to call a bubble in commodities when gold was at almost $2,000 an ounce and oil was at 140. We had sold all those positions. The financial crisis I didn't call because it's an emotional event. It's a quick happening that just happens. It's the same thing right now with international stocks. People are saying, "Jim, our U.S. stocks are doing terrific. Why are we investing in companies like Nestle? Or why are we investing in companies that right now are not outperforming U.S. companies?" Now, the first comment is I'd say, well, that's starting to change. We're starting to see this year international stocks outperform. So this pink line that you see here, the pink line showing you that international stocks are starting to outperform this year. Now, that could not be the case. International stocks could have been down this year, right? And I'd be saying the same thing. I wrote a lot about it in the last newsletter last quarter, and I put these charts in there. It showed you that, yeah, from the period of 1995 to 2001 was very similar to what we've just gone through the last few years, where U.S. stocks have done really terrific. 15+% returns for U.S. stocks. International stocks, 3% returns. Emerging market stocks, negative returns. Well, look what happened from 2002 to 2007, a complete reversal. International stocks way outperformed. They did 15%, and U.S. stocks only did 6% during that period. So it's important to have a little bit of both. Our clients will always focus on, geez, the U.S. stock market's up 11%, and we'll say, yeah, and so are our stocks. Our U.S. stocks, if you look at them this year, they're doing about what the market's doing. If you look at if you isolate just our large cap portfolio, if our clients said, Jim, we just want you to invest U.S. stocks for us, we've done fabulous. The last 8 years, 10 years, we've done 8% a year. The last 5 years, we've done 16.5% a year. It's been incredible. International stocks, we've done terrible, right? We look at our international performance of our stocks the last 5 years and isolate just them. Well, we've made okay, 7% the last 5 years. But the last year, horrible. The last 3 years, just 5%. Again, relative to the U.S. market, instead of 5% returns, we've had 18% returns. So with perfect hindsight, yeah, I should have put all your money on the stock side into U.S. stocks, put everything into American companies and not put them into foreign companies. But that trend is going to reverse itself probably pretty quickly. And that's why I kind of put these charts out here to show you that, especially given the recent outperformance of U.S. stocks, we've had this huge return for U.S. stocks. We're going to revert to the mean and see global companies most likely start to outperform U.S. companies. So I wrote a lot about it in the last newsletter and the subsequent one to that too. And that trend's continuing, and that's why you keep seeing me when I sell a stock like Eli Lilly or an American company. I've been buying companies like Igon. I mean, some of the companies you know about, of course you know about like a Unilever or a Nestle. Unilever makes Dove soap and a lot of things you use every day. You may not know the Dutch company, but you're getting a nice yield. You're also getting about 1% more in dividends from international companies relative to U.S. companies, so that's an important caveat too. And as a whole, everybody's worried about Europe. We're value investors. We're usually going where other people are afraid to go. We're looking to buy things that are cheap. That doesn't mean they won't get cheaper in the short term. Sometimes we're early and they get even cheaper, right? Nestle could certainly go down even more than it is right now. Or we could have a company like Diageo, which makes Johnny Walker Scotch and Diageo or Guinness beer and Tanqueray, Johnny Walker Scotch, Bailey's Irish Cream, Smirnoff Vodka. Diageo could go down in the short term, but I think that when you look at a French company like Total right now, it's an even better buy than Exxon. Plus, you're getting, instead of Exxon, the yield, you're getting almost 6% dividend yield from Total right now, a French oil company, which I would say is cheaper than Exxon, which is yielding 3.6%. So that's why I think that this shift toward international that we've had, I think is an important shift for us to make. And again, these strategies, the large cap and the international strategy and our bond strategy, make up the whole of our global income strategy, which is what all of you are invested in, and what I'm personally invested in with you, is the individual stocks, the 75 or so stocks that we're invested in, and the 80 bonds. And yeah, we're going to have years that I look like a genius and could put my face on Money Magazine, like 2013 when we made 24% and we're in the top 6% of managers. And we're going to have years when we're in the bottom 20%, when, like last year, where we make a less than 2% rate of return. But over longer periods of time, that dividend and interest is always there for you. That's that nice 5%, a little less than 5% dividend yield that you're getting to get you to that comfortable retirement. That's going to hopefully, with a little bit of price appreciation, get you that 7% return that we've had for our clients over the last 12 years. That 5% of dividends and interest plus some capital appreciation to hedge inflation and hedge taxes is exactly what we're trying to do for you. It's just prudent money management. It's creating a balance for you. It's investing not just in U.S. stocks or the U.S. stock market. It's investing in international stocks. It's investing in U.S. stocks, some mid-cap companies, some value companies, and again, a diversified portfolio of bonds for you, so that the income stream is there for you, and hopefully we get some price appreciation for you too. Again, I'll kind of open it up to questions that you may have. I was going to go about an hour today. I've spoken for about 45 minutes right now. I don't want to put everybody to sleep in their dinner, so I'll throw it out for any questions that you may have.
Hey Jim, question. Do we own any Tesla stock?
No, we don't. Now Tesla's a great example of a company that we would just never own. I love the car. I love Elon Musk. I think he's just an absolute genius when it comes to what he's done in both of his companies, Tesla but Tesla is losing, as you can see, $3 a share right now. So they're selling at a ridiculous multiple going forward. I mean, the market cap is huge. They're selling at 78 times earnings. So that's like Joe. That's kind of like saying, let's say that you owned an Exxon station on Highway 23, right, in New Jersey, and let's say you're having good profitability for that business, and maybe you're making $200,000 a year from that particular business. That's like somebody coming by the gas station and saying, hey, I'll pay 80 times earnings. I'll pay you $16 million for your business because I think that traffic's going to improve here in New Jersey, outside New York City. I'm going to be able to get more profitability, and I want to invest in this. I mean, it's a crazy multiple. Right now, without government subsidies, Tesla doesn't even make money, not to mention the fact that they don't pay a dividend. I'd much rather own a boring company like Ford that we own that's selling at a reasonable multiple. You know, when you look at Ford, you're getting paid a 4.2% dividend yield, and it's only selling at a forward multiple instead of 80 times earnings. It's selling at 8 times earnings. That's reasonable. Again, that goes to a reasonable valuation where, again, if that gas station's making $200,000, somebody's saying, I'm willing to pay $1.6 million for that gas station. I'm willing to pay, maybe I'll make up my money in 8 years. If I can make that $200,000 and maybe squeak out a little more profitability, I'll get back to break even in about 6 years time frame. But not only that, not only are we only paying 8 times earnings for Ford, we're also getting a really nice dividend yield. And it's the same thing for Toyota or Honda, which we also own. To me right now, as much as I like Ford and GM, which Ford and GM have gone nowhere over the last 5 years, when you look at, Toyota selling at 12 times earnings and you're getting a 3% yield. So we sold Northrop Grumman and Raytheon and what else did I sell? That was United Technologies at tremendous valuations. We sold those companies. If you look at the last 5 years, we made incredible returns from Lockheed, which makes the airplane I used to fly, and Northrop Grumman, United Technologies. When you look at these companies over the last 5 years, we had 220% returns from Northrop and 180% from Lockheed. And everybody thought that, hey, we're getting out of these wars. We don't want to invest in these companies. They were paying 6% dividend yields and selling at 7 times earnings. We dove into those companies. At that point, Lockheed, and they got too expensive, over 20 times earnings. We sold them. And instead, we got into companies like Ford that really haven't gone anywhere. When you look at a company like Ford that hasn't performed very well the last 5 years, or General Motors for that matter, now we're able to buy. We've sold those companies and moved into cheaper companies that are paying a higher dividend. So Tesla's a great example of when I hire analysts, young analysts. I'll always ask them, hey, what companies do you like right now? And young kids, young 20-year-olds, they're always talking about the growth stocks, grow, and they're really sexy. And invariably, I try to hire younger people because I can inculcate them in our culture. They don't have bad Wall Street habits yet, because people get excited about stocks like that, but those kind of stocks can get just absolutely killed. When you look at the volatility in a Tesla, it's insane. I mean, yeah, it did extremely well when you look at it during those first years when it's just skyrocketing through the roof, but it also has plummeted down to earth recently. When you look at a chart, I mean, look at the 5-year chart. Tesla's up 265%, but look at it the last year when the stock has gone all the way from 270 all the way down to 191. There's huge losses, and then again, boom, it's come all the way back up. I mean, this is just crazy volatility. I don't want this kind of volatility in your life. I would much rather own a Ford where I know we're going to get a reasonable valuation for you. It's selling right now. You can see the stock price has been down, which is one of the reasons why we entered it. We're going to get paid a nice dividend while we wait. And Ford and GM are also investing in nice electric cars too, by the way. I mean, with Chevy, you've got the Volt. Ford and Toyota, of course, has the Prius. Honda has their electric cars. So you're getting electric technology out of those companies too, but it's not a pure electric car like Tesla. So Tesla's a great example of a company I would say, love the technology, go out and buy the car, and it's sexy and it's fast, it's a wonderful vehicle, but don't buy the stock.
Okay.
That was a great, that was a great question on that, Joe.
Yeah, this friend of mine, he bought a whole bunch, and he's making money, so he says. I don't know. But, like it went down, he was losing money. Now he's starting to make money back again. Well, whatever.
Yeah, it's the kind of stock that people like to talk about on the golf course or out at the. He probably wasn't talking about it when it was down to 185, and he lost. You know,
Yeah.
he lost 40% of his portfolio. It has snapped back. If you ask me where Tesla's going to be 5 years from now, your guess is as good as mine. It could be worth $500. It could just as easily be bankrupt and be worth $100. And that's just an uncertainty I can't model for, and I'm not willing to risk your hard-earned retirement assets on something that I just can't gauge. Whereas with Ford, I got a pretty good feeling that, Ford Motor Company right now is selling at a reasonable multiple. We're getting at a good entry point. The stock's been down 17% over the last trailing year. Hasn't really gone anywhere in 5 years. You can see Tesla's up 1,147%. It's just skyrocketed, and we'll see where Tesla goes. But Tesla's like an exciting girlfriend. She can give you a good time for a while, and but she can make your life really miserable too. Whereas, Ford is getting married to a good, stable, prudent woman, and you're going to eat well at night. You don't have that volatility in your life, and you'll have a good, comfortable life, and that's the way I like to invest, rather than in a Tesla.
It sounds good to me. Keep up the good work. Don't stop now.
I'm trying. Yeah, sometimes I wish I invested in the Teslas, and Amazon's the same thing. We'll get questions about, Amazon.com. Really exciting technology. Maybe you're going to get stuff delivered via drone to your house. You go online, order Amazon, they bring the food right to your house via drone. That could be the future, but you're investing in a company with no earnings. And the same thing with Tesla. If I told you that, hey, my company, Altrius, is losing $2 million a year, and we're probably going to lose money next year. If you look at analyst estimates next year, you probably wouldn't in my company, And it's the same thing. It's really the same thing for Tesla. I don't know if Tesla, when you look at the analysts that cover Tesla, and there are a lot of them, right? So you look at analyst estimates for Tesla. Right now they're losing money. There are 19 analysts who are covering Tesla. Some think they're going to lose $3. On the high end, they think Tesla's going to make $1. Again, on the low end, they think they're going to be profitable next year, maybe. $1.45, and some analysts think they're going to make $5 a share. Even if the highest estimate is right, if Tesla's making $5 a share, right? You take the price of the company, $265, divided by $5.30 a share. That means you're paying 50 times earnings for the company. I'm just not willing to pay 50 times earnings for anything. Right now, our portfolio is selling for 16 times earnings. It's very, the stock market as a whole, the U.S. market, we think is overvalued. It's at about 22 times earnings. That's pricier than we want. And you're hearing that about the U.S. market. Our portfolio is not that expensive, though. If you look at our U.S. large cap portfolio, it's selling at, as you can see here, at 15.95 times, less than 16 times earnings. That's pretty reasonable to pay for a great, multinational company that's paying you a 4% dividend yield. It's the same for our international stocks. Our international stocks right now are even a little cheaper. Our PE ratio, again, is below 16, and the dividend yield is much higher on our international stocks right now. So we definitely like international over U.S. stocks at current valuations. That's not to say, again, that international stocks are going to outpace U.S. stocks, because in the short term, your guess is as good as mine. But over longer term, I think that international stocks over the next 3 to 5 years will likely outpace U.S. stocks. So trying to unmute everybody here to open this up for more questions here. Okay, so the mics are open again. Any other questions from anyone?
I guess you explained it pretty well.
Sometimes.
Okay.
Sometimes.
All right. So we won't buy any Tesla stock anytime soon.
No, I mean you can, and so for our clients who like to speculate, and that's what you're doing, you're speculating. So I like to distinguish the difference between investing. So investing is buying a company like Ford, reasonable valuation, global growth potential, GM's moving into China, and gives you a nice dividend. Speculating is kind of hoping that price just jumps and hoping for growth and hoping for that wonderful moment. That can happen, but we always encourage our clients to get little play accounts, open up your Schwab account or TD Ameritrade account and have that little play account and buy those sexy stocks that they could double or you could lose half of your money in them. And sometimes we'll hear from clients and they'll say, geez, my speculative account is beating you this year. And we'll say, yeah, that's it. But most of the time we hear like, I shouldn't have invested in. And people, they talk about their winners. They'll talk about the Teslas, but they'll forget about all the other crazy drug stocks that they bought at horrible valuations and made horrible investments. And when you average all that out, slow and steady wins the race. We're the turtle. We are all about dividends, interest, and getting you a comfortable retirement and prudent returns. Slow and steady wins the race. We don't speculate with our clients' hard-earned money. And so we encourage our clients to open up those speculative accounts and kind of if you want to play, but never invest more than 1% of your portfolio in those kind of crazy speculative stocks.
Okay.
Especially penny stocks that, are really struggling. Anything selling for less than $5 would be, a penny stock. So we might buy you can have a company like Ruby Tuesday that, is extremely speculative in the sense that Ruby Tuesday might do great. It's only selling at $6.43. They're losing money right now. Next year they may make money. But I'd rather lend money to Ruby Tuesday because I don't think they're going bankrupt. Most of the analysts think they're going to be about break even to maybe. So you could double your money in Ruby Tuesday possibly with the stock. We'd rather lend money to Ruby Tuesday and collect that 6.5% interest yield. We think that's a better way to invest, and especially in those more speculative type names.
Okay.
Any other questions out there, or anything else that we could be doing, or anything on the planning side or economic side regarding the Greek situation, or anything else on your mind?
Not me. I'm all out of questions.
Anybody else? I know we got a bunch of people on. Oh, somebody chatted with me here. Let me get this question out here.
Yeah.
Let's see. What about renewable energy companies? There's been a lot of solar fields installed regionally as part of the Duke Progress merger criteria. Yeah, you can. Good question, Lee. You can literally, the renewable energy, so solar companies. It doesn't really matter what solar company is. It could be like a First Solar. Same thing is. In the grand scheme of things, solar is such a small percentage of you can't drive cars, obviously. You can't move trucks on solar, and we can't even convert to natural gas right now. It would take us 10 years to do that, although it's something I'd actually like just from a patriot standpoint. But with cheap oil right now, it doesn't make sense for America to do that. So with energy prices where they're at right now, solar really, at current technology, just doesn't make sense. There are a few profitable companies like First Solar, but still you're looking at 20 times earnings with no dividend yield. We'd larger energy companies that are doing that are investing a little bit in solar to diversify there, whether it's an Exxon or a Chevron. But we just haven't found that sector very compelling right now from a risk reward. There's just too much risk. So you could take First Solar and a lot of the solar companies and kind of throw them into the same category as a Tesla for us, where it's really nice technology, whether it's solar on our homes or whether we go off the grid. And for that matter, we haven't invested in utilities. Utilities are down heavily this year. Again, the dividend yield has come down a lot, and the P/E ratios of utility companies like a Duke here locally in North Carolina, selling at 18 times earnings or 4.5, or a Con Ed in in New York, where you're paying 16 times earnings. These stocks have taken a hit this year because they're just too high priced. Usually utility companies should be about 10, 12 times earnings. So fortunately, we don't have any utility exposure. And again, you can kind of see we've had a massive correction that's occurred in the utility market. If you look at tracks all those companies or Duke, and you look at their returns year to date, you can see this massive sell-off that's occurred. They're all down 10, 11% for the year. They kept climbing there as people were going into yield. They were looking for dividends. Again, we'd rather lend money at 6% to Ruby Tuesday or Rent-A-Center or the companies we own rather than have downside risk with a Duke Energy. Unfortunately, we haven't invested in utilities because they've just gotten hammered here domestically, and we think that trend's probably going to continue as interest rates start to rise. So, good question about solar, but very speculative and not an area where we're generally going to invest. We're the slow and steady. Biotech companies could find the next cancer drug that cures the world, but we'd rather invest in Pfizer than some biotech company that is barely squeaking by. And for that matter, we invested in healthcare companies when they were dirt cheap, didn't do well for a decade. Obamacare really scared Wall Street. Everybody was selling healthcare. And of course, as everybody's selling, what do? We were buying. And subsequently, over the last 2 years, you've seen me sell, just like last week, selling Eli Lilly at 120% returns. You see me sell a big chunk of our healthcare companies where we have very few healthcare companies left. However, overseas is still cheap, so we like owning like a GlaxoSmithKline right now or an AstraZeneca. I mean, GlaxoSmithKline is selling at 7 times earnings with a 5.5% dividend yield. That's fabulous. That's much cheaper than American companies. Same thing about like an AstraZeneca. Where the story is sometimes the PE doesn't look right. You got to look at the forward PE. You're getting almost 6% dividend yield from AstraZeneca, and the company is selling at a reasonable multiple, forward multiple of about 16 times earnings. So that makes sense to us. Whereas for Pfizer right now, it's much more expensive. Any other questions? You can text me one if you don't want to say anything. I'll check out the text. Let me see if I missed any questions here. We got one. Yeah, there were no other questions, but you can text one in here. Just enter one. You can text me in private, or you can just yell over the phone and ask me a question. All right, if not, wrap this up. And again, we appreciate your continued patience and support. We'll keep trying to make you a prudent rate of return over time. And this year is one of those years where we need patience. And eventually, though, we think we'll start to get price appreciation again like we've had in years past, and keep trying to find value for you. But most importantly, get you the income you need to get you to that comfortable retirement. So thanks again. The burden of managing your money is not doesn't pass me. Every day and every night I go to bed, I'm thankful for your trust, and I know it's your life savings, and it's also my income based upon how I perform for you. So it's not something that ever goes away from me. And if you email me at 11 o'clock on a Friday night, you get an email back. And that's part of my commitment to you as always. So thanks, thank you for that continued trust. And email me or call anytime. So thanks a lot. All right, and good night, everybody.
Good night, Jim. Enjoy.
Take care, Joe.
Up the good work.
I'll try.
it.